I really do. I'm with Jim. Should not be a shock. But I think the key thing here is this term normalization. We talked about normalization of the bond market, but we haven't really at this table here talked much about normalization in terms of equity performance and earnings growth and valuation. I think that's where we're going. I think it's kind of back to old school, old time hockey, back to the 80s and 90s. And part of our forecast would be kind of high single-digit returns for the next 3 to 5 years, single-digit earnings growth, 3 to 4%, 10-year Treasury. That's a pretty good environment. Value stocks over growth, small and mid. We made the call. It's the first time in 11 years that I've been overweight small, mid versus large because of the cash flow and the balance sheet strength of those areas, Scott. But the earnings really is the key. And you and I bantered back and forth for several months now that the earnings period was not going to be as bad as everybody thinks. I think earnings for the fourth quarter will probably come in flat. Right now they're down 4% or something like that. I think they've done a really good job cutting numbers. I think what's going to end up happening is a lot of the weakness that even we thought was going to occur the first half of the year got pulled forward into December. And everybody and their mother, brother, sister, cousin, uncle that does what we do in terms of strategist says weak first half, a bottom in May, June. That means, to me, it's going to happen faster.
The idea that earnings may not be as bad this quarter, and they weren't as bad as people thought in the third quarter, so there's no reason to believe they're going to be horrible in the fourth quarter, it's a fake tell. That's what Weiss would tell you, because it's all about what's coming. And don't be confused by strength in the third quarter or strength in the fourth quarter, because all that the Fed has done and will still do through not only their rate hikes, but their quantitative tightening, et cetera, and these effects that are taking place in the economy, haven't seen the bulk of job losses yet by any stretch. It's all going to come to roost. It just hasn't yet.
Well, I think let's take for
Isn't that the base case?
That's the base case. I think.
So you agree that's the base case?
I think that's the base case because we haven't seen the big drop off in employment, and that would be the one thing that would scare me if we actually do see a higher spike in unemployment. But going back to what you said, you need to take 2 steps back. Today's comments with respect to the banks are very important, because the banks have not had an opportunity to do what they usually do, under promise and over deliver. And I think what you've seen and heard so far from JP Morgan and Bank of America, they set themselves up to do that. And I think that sets the tone for the entire rest of the market. Now, tech stocks clearly got crushed, multiples have come down, but the big cash flow generators, I think, are going to have better earnings as well. So I think we're somewhere on this table here. I think I'm probably somewhere between Jim and Shannon in terms of near term. Longer term, obviously, we're very bullish, but I think the market actually will see a low before May, June.